So investor allocation, and the another word was like the drawn down. So what is the meaning of drawn? Are you aware about this word? The drawn down? Drawn at least. Down, that is, it means like we are reducing it. That's it. Drawn, it means withdraw. Can we say that? In a PE, what we withdraw then? Capital, correct? And then once we withdraw, it means what we do exactly. Actually, we are reducing or drawn down. So it means we are reducing the capital of an investor. Simple. So that activity we call drawn down. What happened, I'll tell you. Suppose in the initial amount they have contributed around 100 crore and it was invested into two companies, 50 crore each. So let's say this is MobiWik, Quick or Wik something, I forgot name, let it be. And this is Zomato. Zomato, it's been listed now, correct? And once it is listed, it means Zomato will receive funds from the Zomato. So funds will receive to the PE house, correct? Private equity house. And once the fund received to the private equity house, they will have to repay this return of capital to the investor. So it means when you suppose today we have processed this 50 crore to the investors, and when suppose let's say yesterday we have processed it and today we are doing the accounting for this particular PE fund. So we'll record 100 crore or we'll record only 50 crore that is still invested into the movie. So we'll record only 50 crore, right? Or we'll do the accounting for 50 crore because yesterday we have processed this 50 crore to the investors. Correct? Are you getting me or not? Any doubts? You can ask. So it means this capital we have drawn down. Another term sometime they can used which is principal pay down. Principal pay down. So we are reducing the amount from the main capital and we are actually processing that capital to the investors. So that process called as drawn down. Okay. Drawn, it means it's simple. It's a withdraw the capital from the business. And when you withdraw, even you can see the in a balance sheet as well that we lease that amount from the main capital amount. As simple as that. So this was the new that we forgot to actually discuss about it, but you can add into your notes. And the another which is investor allocation. Investor allocation, see, it's very simple. What we allocate to the investors. We allocate capital or their contribution that you can call, correct? Then withdrawal request in other side. Then gain, which is capital gain. Okay. The other hand, the losses, if we lost any amount from XYZ entity, we'll have to allocate that losses to the respective investor account, right? Because this investment is belong to or pertain to the investors. They are actually owner of this particular investment. So it means they will have to bear the losses from this investment. Correct? Then the income as a preferred return here we expect, which is 8%. And other hand, okay, expenditures as well. Expenditures in terms of management fees, correct? Which is 2% or up to 2%. Then incentive fees up to 20, and other fees. And return, that is, we generally do the provision for a preferred return on preference equity and bonds or debt obligations, I would say. Okay. So when you allocate this, because this will have to allocate on a even daily basis as well. Because when you see the movement in a expenditures, maybe in a incentive fees, maybe in a withdrawals or capital contributions and all, so in that case we'll have to allocate that particular amount to the respective investors account. So this activity we call as an investor allocation. Okay, so if you see any questions on this, so you can raise this point. Capital gain, preferred return, expenditures, that is fees and all, then losses or withdrawal request, and also will have to allocate all these things to the investors account or individual investors account, and that is as per their contribution. If someone have contributed 2 crore, then we'll have to allocate as per the 2 crore class. If someone have allocated or contributed 1 cr, then we'll have to charge the fees. Means it depends on their capital, as simple as that. So on the basis of that, we'll charge the amount and allocate it to the respective their own account. So this activity we called as a investor allocation. That's it. Correct? Okay. So here that we already discussed, a number of things about the private equity, right? And apart from that, trust me, nothing can be different in the interview as well. So hardly the two things that would like to add, because I want to cover the every aspect of our this private equity segment. So there are types of private equities, because we have discussed about the different companies, the way the P funds invest into the variety of unique businesses, correct? But apart from that, private equity firms, they invest into the real estate segment as well. So how they invest? There are even in a real estate there would be a types. One which is residential, project. So this called like Rere something. I forgot this name. Real estate private equity. Private equity in real estate or real estate private equity fund. Okay. Residential equity private equity fund, and another would be commercial private equity fund. Simply if the fund is helping to any commercial project, so that fund would be your, or that the investment categorized as a the commercial private equity fund. And if they are contributing or providing funding to the any real estate or residential project, then that project investment you can call real estate private equity, sorry, residential private equity fund. Residential and commercial. Okay, so that's two names you can expect into the uh, that the private equity accounting. Why it is important? Because here you cannot calculate the, the net asset value per unit very easily, because it's very difficult to calculate it, because most of the projects should be in work in progress, then only you do the funding to complete that project. Correct? And once the project will be complete, exit strategy will be executed. So this even strategy you can call return of capital. Okay. So even it's very difficult to do the valuations of a work in progress status projects, and that is what sometime are you aware about home loan? Because how they do the, if suppose your the property is in under construction status, then how, suppose you opted for a bank loan, then how the bank proceed the loans? Correct. The same way PE funds work. They do the funding in a stages. First, second, third, maybe fourth if it is required, or maybe fifth, depends on it. And that is on the basis of the project progress. Okay, so this is like top up information for you. If they raise questions on it, so are you aware about how they do the funding to the real estate project? The way home loan works, the same way they sign the agreements with the respective builders or promoters, and they provide funding to the business to complete that particular project. Otherwise, see, if there is no funding, then even so builder also cannot complete that project. Okay, because project every big project behind that there would be a private equity investment, and then only you can see the project has been completed successfully, because funding is the key part, so which will help to the real estate companies to complete their project. And once it is complete, then the builder's responsibility is to sell that project into the market quickly, and then only they will receive the fund to recover that amount. Otherwise it's a bit difficult to hold because they cannot hold for a long. There would be a cap, right? So it will be a deadline that, so within 5 years or maybe 2 years builders will have to complete that project, and then within a 6 or 7 months they will have to process for a selling as well. And once, if they sell everything, and then only they will receive the amount so they can distribute. The rest things should be remain same. There is no change in the procedure, but it is like, the one segment, this is for again diversifications or investment purpose. The private equity funds, they are investing into it, so that we should know. If if you see any questions come across on this particular part, so at least you should aware about it. Yes, I'm aware about it. So nowadays the P's are investing into a real estate in a residential project as well as in a commercial project as well. Okay. Hmm. Okay. So today, so what we'll see, this is a statement, okay? Financial statement for a private equity. This would be the last session for PE. I'll forward this template to you. You can even read it, but I just wanted to discuss few things about it, how they prepare and all. But this is not from an investor side, okay? This is from a, exactly, because we do the accounting for both PE investor and private equity house. So always we should know that we do the accounting for both. Then shouldn't be difficulty to understand. So how we do the accounting for a private equity and how we do the accounting for investor. For an investor, they will do the accounting or will do the accounting for their own contribution only, or investment, their own investment. And here we'll do the accounting for all asset under management, including asset invested into the different portfolios as well. Okay, so we'll see then. We'll jump on the balance sheet part. This is your balance sheet. These are the accounting standards. So this is for just a guidance. Okay, so you can see the disciplines if you want. This part. Yeah. So this is for a private equity limited partnership firm. See their statements. Investment at fair value. Even you can say like current value as well. Current market value. And this cost, which is something you invested value. So we should know that always we should know the difference between these two. Because when you calculate the profit, we always do the calculation like cost minus so value which will receive after sell of this particular investment. cash and equivalents, which is a normal term, cash at a bank, or the cash which we have available in our books of account, right? Then interest and dividend receivable. In a private equity, why they are mentioning about this too? Because as already we discussed about it, so the P firm they will make a provision for a preferred return, and the preferred return would be in two forms: one which is dividends, and the another one which is in interest form. Okay, because on a preference equity they will receive dividend, and on a bonds they will receive interest payment. As simple as that. Due from related party, so any amount can be due. Okay, any amount. So it means it's like the bills receivable, the current assets of the business, right? So same way here they have used term which is due from related counterparties, escrow processed and receivables. So this could be the from a tax or insurance point of view, or any claims if they have yet to received, so which has been declared but that yet to received. So in that case also they're gonna record that particular escrow amount on their balance sheet side or asset side on the balance sheet. Then the capital contributions receivable from a XYZ investee companies and other assets. These are the normal terms, okay? There is nothing new. And the same statement even you can see in the actual private equity firm as well, but not in a daily accounting, because in a daily accounting there would be a different terms. This is like the financial statements for a annual basis, that because if you can see, so they have prepared for a entire year 2020, 2020, sorry. See the liabilities: management fees payable, capital distributions payable, notes payable, which is something any uh, documents or obligations if they have signed, so they will call as a note. Then accrued expense and other liabilities, and the rest would be the partner's capital. Okay, so very important, that one point which I would like to highlight here. If you see, most of the time you can expect questions on, if you have received some request for a subscription into the private equity fund, so would that affect on the per unit price, or maybe the per net asset value? Sometime you can expect questions on this. So in that case, if you see any withdrawal or redemption request, there won't be impact on the per net asset value. The reason I'll tell you, because when you return the capital, so always you will try to return the capital from the cash equivalents if the amount is small, correct? So it means your assets will be decreased. The same way we'll have to write down or dilute the number of units from the partner's capital as well. So it means proportionately your partner's capital will also reduced if you are reducing the assets, and the same way if you are reducing the partner's capital. So it means there won't be any impact on the asset or on the even balance sheet side, liability side. So eventually there won't be any impact on the net asset value. So nowadays this question is becoming very popular because most of the interviewers are asking questions on this because they know that we are not aware about it, means the person who is there in the interview, so they are thinking so the guy is not aware about it, this particular terms. That is what I am just clearing this at this point of time. So you should know that the impact if we are paying something, so what will happen with the balance sheet, because proportionately we'll have to debit something. So again, so we'll have to, if we are reducing the assets, then we'll have to reduce the liabilities as well proportionately. Correct. So there won't be any impact. So it will clear this term in a mutual fund session or hedge fund session in a very, because in a P it's a bit difficult to to calculate the net asset value and all. That is what we do, calculate value, the per net asset value on a quarterly basis with P. This is something interesting for us. See, another schedule of investment statement that we'll have to prepare while preparing the financial statements for a P. This is percentage of partner's capital, correct? Cost, invested value, fair value, current market value, or sell consideration. If you sell, you will receive this. Simple. Sell value. That is what you are saying, the difference between these two. Okay. See how they are doing the accounting. So the first company is from a consumer technology, right? So company name would be private consumer technology company 1. So how they have invested? They invested into the preference stock, common stock, notes. It means it's bonds, right? See their percentage, 22% into preference, 4.2 into common stock, and 1.5 into notes. The another company again, private consumer technology. Yeah, this is the same company, but they have invested twice eventually. So this should be for a first round and this should be for a second round. Warrants and preferred stocks. Then the another company is from the healthcare domain. See this. The healthcare, private healthcare company 1. Preference and common shares. From a same domain, they have contingent consideration. I'm aware about contingent, but consideration, so we'll have to see this, what they're saying. Okay, 2, the fair value for this. They didn't invest, but still they are saying the value. Anyways, the third, total United States. Okay, so this investment in from the United States, which is 59%. Another investment is from China, consumer technology, private consumer technology, Bond notes, preference shares. See this, which is 5.6%. Total private operating companies holding, which is around 64%. This is the capital amount, and this is the current value which they have. An accountancy policy election should be made as to whether the contingent consideration is recognized as a financial assets. Okay, measured at a fair value or treated as a gain contingency under the topic 450 contingencies. So this is continued from the above one. Okay, then marketable equity securities, United States consumer technology, public consumer common stock, public consumer common stock, and this is the total, which is around the total marketable equity shares 34% again from the US. And C, total investment at fair value, which is around 99%. This is the total investment holding, and this is the current market value. This is this is the structure how they had invested into 50% from the preferred, 45% from the common stock, 2.5% into the bonds, means they have invested through the notes or bonds or debentures or any obligations, and total warrants, which is 0.6%. Warrants that we'll discuss with the in a corporate action section session. Notes, it is like it's a bonds. That's it. I'll take one overview sessions for you. So we'll discuss all the financial instruments. So what are the financial instruments and how they do the trade into the market and all. From which platform and all. So we'll take 1 hour session on it and we'll discuss about it. Okay. Statement of operations. See what are the incomes items that we'll have to mention, that is interest payment, because we have discussed about it as a preferred return. See the value of interest payment. Then dividend. See the value of dividend. Then other income. And I think other income they took as a this contingent consideration. Hmm. They have received any other income, so that is what they took it as a consideration income. Total income. And these are the fund expenses. Management fees gross, management fees offset, and the management fees net. And why they will do offset? Because if they have paid any fees in advance for a next accounting period, so they will offset into it, and only they will consider the net fees for this particular accounting period. Professional fees and others, so they should be the incentive fees, and the other fees, due diligence cost, broker deal cost, and interest expense and all. So all the expenses, those are the fund expenses. See, because we have discussed about the income, so we'll have to allocate. Now here you can understand the allocation part. We'll have to allocate the income as well as expenses as well. To whom? To the investor's account. Okay. So in this case, till here, so it seems we are in a loss because we have a negative figure. Expenses are high, then yes, we are in a loss, net loss that we have. This. Then realized and unrealized gain, loss from investments and foreign currency transactions. Net realized gain from a investment. Why we'll have this? Understand this because if suppose your investments that is still your you can see in any companies, so that means that is your realized in that is your the realized, it means once you execute the contract, so it means whatever amount we'll have, that would be your realized one, right? Yeah, and suppose still if you see your investment that is into the any company, but that yet to matured, so that investment would be your unrealized. And if you see any gain on it or any loss, it's like the difference between the cost and the value that you have at this point of time. So it means like investment value and your the current market value. That's it. So this difference would be treated as a if the investment is still on or that is into an XYZ company. So it would be like ongoing investment, and when you see any negative or positive figures, accordingly you can treat as a unrealized gain or loss from that particular company. Net realized gain from investment they have around this. Net change in unrealized gain and losses on investment, still it is a positive amount, means the invest they have unrealized gain here also. Net realized gain from foreign currency transactions, net change in unrealized gains and losses on a translation of assets and liabilities denominated in a foreign currencies, and net gain from investment and foreign currency transactions. So finally here they are in a profit after calculating everything. Even this profit also will have to allocate, or an income that will have to allocate to the investor's account, because this investors this investment is from the capital which is invested into the P, and that capital is from the investors. So whatever gain that we see on the investments will have to allocate it. Simple. This is the breakdown between the general partner and limited partner as per their contribution. So they have just allocate the heads income, realized income, loss. If you see the net loss, right? It's been divided or split into two. This is the total one, and these are the splitted one. Their capital. This is beginning. It means capital that we have allocated. Then contributions that we have allocated. Capital contributions. Then the net income or losses, whatever we have that we have allocated. That's two. If you see this amount, because this is the total. So till here, what we have done, we have prepared the financial statements for a PE. But here, if you see below, we have prepared financial statements, or we have allocated all the expenditures and income to the general partner and limited partners accordingly, because as per their contributions, right? If you see the total here, so it means here, so what you can understand, we'll have to allocate each and everything to the respective investor's account, because that is not our assets. And the very important is, so at the time of launching, or initiating this particular PE scheme, the general partners, they will have to contribute their own contribution as well. That is, it should be at least 20%, and the rest would be from a limited partners. And this is mandate nowadays. At least for India, it is mandate. If the size of the investment is around 1000 crore, then they will have to contribute at least 200 crore. Then only they can launch the scheme. That's it. And that is what will have to prepare or allocate the all the activities between the limited partners and general partners, and that is as per their own contribution, right? In a GP also you can see the many players as well. A, B, C. Here would be like X, Y, Z, E, and all. So we'll have to allocate this 80% into this 4, and we'll have to allocate this 20% into this 3. So we'll have to allocate everything: expenditure, losses, capital gains, everything means everything. So this activity we call actually the investor allocation. And this is how they prepare the financial statements as well. So you can read this financial statements, especially if you want to read, then read the sections as well, because you're doing the course that is would be more relevant to this. Okay, try to read the sections like this. The rest, the content, which are very uh, simple, that even we don't need to discuss much about it, but at least the sections and the the terms or accounting standards you can read. Especially you can read the below part. Such a part that you need to actually read it about, because the fair value measurement, how they do the fair value measurement. Okay, the calculations, see their how they have calculated the the net value, how they have calculated the fair value and all. Okay, yes, I'll send it to you, because I'm just highlighting the things so you can read it accordingly. Here also, that you can read this about the organizations and all who do this. Okay, about the organizations. Here also you can read this appendix. Okay, try to read all the appendix part. So this is basically the description how they have considered the factor to prepare the statement even. Okay, and this is for this fund actually, Delaware Liability Limited Liability Partnership from US. Read this, and then only hmm, this one also. Try to read the appendix part, because more input or insight you can find here only. The rest, the format and all, it is like once you go through it, it can easily understand. There is nothing is difficult terms there. You can see there, but you need to read all the sections, all the terms or description things, because in that you can find more and more the clarifications on the statement parts, then the other factors how they have considered to prepare the particular section or value or calculate the value and all. Okay.